Markets. Mark Todd is standing by. He's the Director of Institutional Relationships at FIIG Securities. Mark, good to see you. Thanks for having a chat with us about this today, because we really just want to get a sense of what this means, not, I suppose, so much for Woolies, but for the broader market. How has it been received so far?
I mean, it's been led by ANZ and Westpac, and it'll be well received already. I think 110 over it is comparable to the CBA retail bond at 105 over, and I think it'll be pre-sold. It should be quite well regarded. It's got a credit rating of S&P A-, so that opens it up to a range of institutional investors, and so I think they'll have no problem selling that.
Are you seeing an increase in this type of issuance? You mentioned CBA, but is it happening across the board, or are they still a little bit choppy, a little bit one-off?
I think it's fair to say that recognisable names are easily sold at the moment. So if you look at, there was an RBS 3-year last week. They came to the market looking for $500 million. They end up selling $1.5 million. Sorry, $1.5 billion, I beg your pardon. And of that, $1 billion was 195 over the prevailing cash rate of BBSW. So that was pretty well received. I mean, it was a good number.
You mentioned RBS there. Did that seem expensive to you?
I think RBS has a slightly different view on the way it funds itself. In respect, it has a feel-good effect. In other words, they go to the investor market and they leave a little bit on the table. And so I think that's it becomes easier for that sort of issue to be sold. I think it's one of the areas that we are a little bit weak in the retail space, where you don't have the same sort of feel-good effect.
Okay, but you're talking about money. It's not just about feeling good. There must be some other benefits beyond that.
Oh, I think what it does, if you come to the market at a reasonable rate, like 195 over was a good rate, it makes your cost of distribution a lot cheaper. So, as I said earlier, they wanted $500 million, they end up getting $1.5 billion. So to them, that total cost is quite good. And it looks like if you were going to an ANZ or a Westpac and you're offering a good rate, you don't have to pay the same sort of margins. With an RBS, they've got their own distribution, so they're able to distribute a lot of money straight into their funding. So and that's what we mean by the feel-good effect. The investors come to the market saying that'll be a consistent issue. The last time they came to the market, RBS paid 240 over, so the investors like buying their assets.
What, Mark, just back on this Woolies issue, what does it say about, I suppose, the broader market here in Australia?
Oh, I think it's opening up its debt markets well. I mean, I think there's a lot of money in Australia, and I think they're all coming to the market. We saw a drop in some of the kangaroo bonds, and so the corporates are looking to take advantage of people wanting fixed income. I mean, they're good assets.
So there's plenty of, I suppose, money sitting on the sidelines at the moment waiting for issues such as these?
Well, I think there's always a constant rebalancing of people's portfolios, so I think they're looking for these sort of A- credits. I think they're looking for debt in general. So you see the volatility in the equity market. You'd like to think that you'd have a balance around the cash, the term deposits, which we do a lot of that here at the moment. You've got the term deposits and then the bonds and then the equity. It's just that rebalance all the time. It's a consistent message. Make a balanced portfolio.
Has there been, or have you seen increased demand, I suppose, for these kind of issues since we have seen, the global unrest, given what's going on in the Middle East? Are people sort of moving a little bit back towards somewhat safer assets?
I think if we split our market between institutional and retail, I think in particular the retail space is getting more conservative, so they're looking for more reliability and returns. I think the volatility is really hurting. On the institutional piece, maybe they're trying to take advantage of that volatility, but broadly speaking, debt markets are attractive levels at the moment. Okay,
so your retail clients are quite keen on this sort of stuff at the moment?
Oh yeah, retail clients are keen on the bonds. I mean, I think we're seeing a real growth in a change of philosophy around where let's call it the annuity piece is. As you get older, you want to have a consistent revenue return. You don't necessarily need to be buying and trading a lot of these equities. And there's a lot of inconsistency around in the equity piece where, you've got Rio Tinto coming out saying we're worried about carbon tax and the effect on different equity pieces. There's a lot of different messages coming out on equity that might make it hard for people to try and trade that thing. And I think people look to buy debt. Okay,
I guess I should just ask you, I mean, we've sort of had a bit of a big picture discussion around what this issue says about the market here, but does it signal anything to you in particular about Woolies and the way it's managing its books?
No, not at all. I think that's just a smart business play. I mean, I think they're taking advantage of demand in the market, and I think the Woolies Treasury will always be looking and fielding phone calls from all the banks at appropriate times to try and issue new debt, and I just think they're responding to the right level of debt.
All right, Mark, Todd, good to speak to you. Thank you.